Thank you for joining the webinar. My name is Ryan Gibson with Spartan, and I wanted to first start with the story about how our Houston investment opportunity came about. When we look for opportunities at Spartan, we're not just looking for storage. We actually look for more of a strategic advantage, and that starts with location. And so for over a year, we combed the Houston metro for institutional quality self-storage properties in the right neighborhoods. And we saw plenty of Class A assets, but most had already been picked over, professionally managed, fully optimized, and priced like it. And this portfolio came across our desk. It was 7 properties, all Class A, climate controlled, and all in the most affluent, fastest growing suburbs in Houston, places like Sugarland, Cypress, Katy, Rosenberg, and Summerwood. And yet these properties weren't professionally REIT managed, and they had never been touched by a REIT management style company. Their rates were below market, their operations had been efficient, but the bones were there, and the upside through operations was there as well. Currently, the operations are inefficient, so we made some calls. We reached out to the top 3 REIT-level storage operators, and the response was pretty immediate. In fact, not only did they want to property manage these assets, but they wanted to buy them outright. And that's how rare this is. But thanks to our longstanding relationships and Spartan's reputation for being a great steward of these institutional quality storages, we were able to win the deal, even though we weren't necessarily the highest bidder. So now you have the opportunity to participate alongside us. You're getting access to some of the highest quality self-storage real estate in the Houston market before it's been fully optimized, and before any institutional players can bid it up. So with Spartan's partnerships, fine-tune operations, and hands-on approach, we're confident this portfolio offers long-term appreciation, monthly cash flow, and the kind of market positioning you just can't replicate today. Our legal disclaimers is we're not offering any tax, legal, or investment advice. Do your own due diligence and consult with your tax and legal teams. This is just a general overview. And for complete offering details, you can visit our investor dashboard, where we share all the information about the investment. And today I'm going to talk about why we love the Houston, Texas market, the investment, a little bit about Spartan, why we love self-storage as an asset class, get into the investment details, and really dive into each property, and then end with the investor benefits and the next steps to invest. So let's just start real quick with who we are. Spartan Investment Group is a vertically integrated real estate private equity firm based in Golden, Colorado, with an office in Seattle as well. We specialize in self-storage, and we've built a platform designed to deliver performance through discipline, control, and alignment with our investors. We started in 2014, over 10 years ago, and today we've executed over $800 million in self-storage transactions across the country. We're not just investors, we actually operate and improve what we own. And today we operate 78 self-storage properties across 15 states, making us the 36th largest operator in the United States. And that scale matters because it gives us the purchasing power, market leverage, and deep operational insight. And because we built everything in-house, construction, property management, and asset management, we have full control over the execution. When we underwrite a deal, we know exactly how it will operate because we're the ones doing it. And our strategy has always been to follow the fundamentals: population growth, job growth, strong demand with constrained supply. And that's led us to markets like Houston, the Southeast, and the Pacific Northwest, places where storage just isn't needed, it's thriving. And that's what's led us to this next opportunity in Houston. And over the last 10 years, we've completed 16 full cycle investments. And here's something we're really proud of. We've never had a capital call. We've always produced an investor positive return, and we've never lost principal. And that's consistency is no accident. That's the result of our conservative underwriting, disciplined acquisitions, and active operational control. But behind every deal, there's a team. And we believe ours is one of the best in the business. We have over 150 full-time team members, and we've built a culture of operational excellence. We've been recognized on the Inc. 500 for the last 5 years in a row, the Vet 100, and the Best Places to Work, and it shows up on how we serve our investors and operate our assets. But when we pivoted to self-storage, we were looking for an asset class that was easy to maintain, evict, and operate. And that's what we call the 3 E's. But we also wanted something that had long-term demand, and that's what storage delivers. In the 1990s, Americans used about 2 square feet per person, and today that number has tripled to over 6.5. We've seen usage grow across all demographics, downsizing families, remote workers, small businesses, and it's a long-term trend, not just a short-term spike. But Houston is a top self-storage market, and it's still growing. The metro actually adds 190,000 new residents annually, and with our portfolio's 3-mile trade areas, the average population is nearly 97,000 and growing at 3.05% per year. That's 4 times the national population growth average. And these neighborhoods also boast household incomes of 135,000, creating durable, long-term demand for high-quality storage. Each facility is embedded in mature housing, dense suburbs like Sugarland, Cypress, Katy, and Spring. And these are irreplaceable locations, surrounded by rooftops, locked in by zoning, and protected by high land cost. Infill sites like these, they simply just can't be built again, which makes them more valuable with time. So from a construction standpoint, this portfolio checks every single box. We're talking Class A, climate-controlled assets with superior build quality, modern design, and optimized unit mixes. They're already well built and well located, delivering minimal CapEx risk and operational efficiency from day one. And now we're basically taking these and unlocking their full potential. These facilities are transitioning from a mom and pop ownership to REIT-level management, the same strategy that we've executed successfully on past projects. But I thought was interesting is on average, REIT managed facilities outperform by 10%, and Spartan's partnerships with the national REIT operators are designed to capture that premium, maximizing the yield and creating long-term stable cash flow for our investors. So here are the target returns for the business plan based on a Class C investor. Just over 18% annual return, 14 IRR, and double your money over the 6-year planned hold period at 2.1x multiple. Now, I wanted to give you a tour of all of these properties. Now, take a look at this one. What you're seeing here is one of the 7 facilities in the Houston portfolio. And what's remarkable is that 5 of the 7 assets were built using the same high-quality blueprint. That means consistency in operations, efficiency in maintenance, and predictability in how these sites perform. Each of these facilities is 2 stories, thoroughly laid out, primary climate controlled, meeting today's renters' expectations. And these are equipped with convenient drive-up units along the exterior, and they're designed with a professional retail-style leasing office situated on large parcels with ample parking and circulation. And I think what's critical is every one of these sits on a high traffic road with excellent visibility, positioning them as the top of mind for storage in the neighborhoods. And these weren't just afterthoughts. They were well built, well located, and purposely designed by the original owner who understood the Houston market and develop them for the long-term hold. And what's exciting is they've never really had that professional management, so while the foundation is already best in class, there's still meaningful upside up ahead. Here you can see every facility has these exterior drive-up units, one of the most tenant-requested features in self-storage and a key part of why these properties remain so competitive in their submarkets. Each site has these concrete drive aisles, not asphalt, so they hold up better over time, reduce maintenance costs, and reflect a higher construction standard. And they're spacious, well laid out drive-up access, which attracts a broader range of tenants. Think like contractors, small businesses, anybody needing easy, frequent access. And notice that 14-foot awning. That's a unique design feature across the portfolio. It allows tenants to load and unload comfortably out of the rain or the sun. It's a small detail, but one that adds really valuable thing to the customer experience. And that shows in the retention that these tenants have. Now, this is where the portfolio really stands out. Most interiors are purely functional, basic lighting, concrete floors, and not much more. But here you can see the level of pride and intentionality that went into these builds. Each facility has double LED lighting, making the halls feel bright, clean, safe at all times. And the owner even installed carpeting throughout the interiors, something you almost never see in self-storage. And his goal was simple: make the experience feel more welcoming, more professionally, and ultimately a cut above the competition. So there's also background music playing throughout the buildings, another subtle but meaningful way to elevate the customer experience. And so these design decisions may sound small, but they really create a premium atmosphere that's hard to replicate, builds brand loyalty, and keeps the tenants staying longer. So this one, while most of the portfolio shares that consistent blueprint, this property in Sugarland stands apart in all the right ways. It actually is a true drive-through facility. And you enter through a garage door and you drive directly into the building. That means that tenants stay completely out of the elements in a fully climate-controlled, well-lit environment year-round. So it's the only facility of its kind in this submarket. And it's really just, it sits at the intersection of high residential and premium retail, in one of the most affluent corridors in all of Houston with direct covered access to your unit. This layout caters to upscale users looking for a frictionless storage experience. And that gives us pricing power. In a market where renters are expecting best in class, this is the kind of asset that feels more like a high-end service than a storage facility, and it really reflects exactly the kind of long-term, irreplaceable value that our investment strategy is built to capture. Now, taking a quick look at the portfolio by the numbers, and what stands out really is the consistency and the quality of the submarkets. The average household income within 3 miles is over $135,000, with some markets in Sugarland reaching over $200,000. And population growth is another highlight. Katy and the Champion Forest are growing at 5.4 to 5.5 annually, and Katy is experiencing a 58% surge in the last decade alone. And even in the more stabilized areas, you can see healthy growth trends in incredibly dense areas. Eldridge, for example, has 151,000 residents within 3 miles. And from an operations perspective, average occupancy sits just under 85%. And that's a clear signal that these facilities are already performing well, but we have room to optimize through professional management and marketing upgrades. This portfolio that blends scale, stability, and upside potential, and these metrics really enforce why we believe in the long-term value of this investment. So now that you've seen the strength of the locations, let's talk about how we unlock the upside. The current owner built and maintained these properties really well, but never really implemented the pricing, marketing, or operational systems that we see in institutional quality portfolios. And we're partnering with some of the top REIT managers to take these assets to the next level, professionalizing revenue management, tightening operations, and increasing NOI, all without any major capital improvement expenditures. And that's the Spartan playbook. While these properties are high quality, they've historically been operated by a single owner, and that means that no professional revenue management, limited digital marketing, and no tech-enabled leasing. And our plan is to transition the portfolio to just that. And that's going to improve our conversion rate, ultimately the NOI. And the best part, these are Class A, well-built assets, so we can do all that without a major capital improvement, and that is exactly the type of investment that we specialize in. Top-tier real estate that just hasn't had the management that it needs yet. So let's talk about the assets in the portfolio. The first one I want to talk about is Sugarland, and specifically the First Colony neighborhood, which is widely recognized as Texas' premier suburban community. This facility uniquely is designed through the drive-through climate-controlled units that I talked about earlier, known for exceptional schools, upscale homes, and restrictive zoning. And this area offers stability, high incomes, and exceptional quality. So it's in the heart of the retail, has great demographics, and it has those premier drive-up units. Looking on the inside of the location, you can see that just over 60,000 net rentable, mostly climate controlled, and it has that really strong physical occupancy and was built in 2011. Now, talking about its location, this facility is flanked by multiple corridors that have well over 100,000 cars in totality traversing the site. This is also home to some of the nicest retail in the area, and I'll show that in just a second. But if you look at the location of our property, you don't want to really be in the mall. You kind of want to be in the neighborhoods. That we straddle the best of both locations. We have dense residential neighborhoods, and we're right next to high quality retail such as Shake Shack, Whole Foods, some of the more higher end retail sections that this area commands. The demographics are some of the strongest household incomes in the area, with over 1,700 multifamily developments coming within the 6 mile trade area. Now, getting to the next site, Champion Forest, this one has a dense residential base, very high income area, and strong population growth. It's located in an established, affluent northwest suburb of Houston, and the area is growing at 5 times the national average, boasting strong school districts, upscale amenities, and it's right next to the Champion Forest Golf Course, which was the home of the 2020 Women's PGA Championship. And this offers, again, nearly 60,000 net rentable square feet, over 500 units. 75% of this is climate controlled, strong visibility in a highly residential corridor. It was built in 2003 and has great physical condition, no capital improvements needed, and the current occupancy sits at just 81.6%, giving us room to optimize rents and operations. And this is a 2-story asset that's already positioned well, but we believe that institutional management will help unlock its full value. The site is one of the most desirable, and it has over 25,000 vehicles passing in front of the entrance. It's surrounded by nationally recognized retailers such as Costco, Kroger, Target, all of which signal strong customer demand and create daily destination traffic that keeps this location highly visible. And this is just a textbook example of an infill, high barrier to entry submarket. And it's exactly the type of location that a REIT or some institutional buyer is eager to own long term. And it's an established neighborhood serving over 108,000 residents within a 3-mile trade area. And that's growing at an impressive 5.4% annually, which is 5 times the national average population growth. Going to the Stubner site, this is in the heart of Spring, Texas, an area that's already seen residential growth over the last decade. And this is positioned along Stubner Airline Road, which is a main north-south artery with strong daily traffic. Excellent visibility. It's surrounded by single-family neighborhoods, retail centers, local schools, placing it right in the path of the day-to-day community movement. And what's noticeable is just the lack of competition around this site. The surrounding market is largely made up of Class B and C facilities, giving us a clear edge with this well-maintained asset. Now, this is over just 87,000 net rentable square feet, 594 units, and a well balance of climate controlled and the drive-up options. And 75% are climate controlled, which aligns with our customer expectations in this part of Houston. It was built in '06, remains in excellent shape. This is a clean, high-quality 2-story Class A facility, wide drive aisles, good curb appeal. And again, it's sitting at just about 90% occupancy, meaning we're coming in with strong in-place cash flow and plenty of upside through revenue management and institutional level marketing. Here's the location. It's demographically attractive trade area. Within 3 miles, we have a population of nearly 127,000 residents, and that is growing at 5.5% annually. That's 5 times the national average, over that. Moving into the Summerwood location, probably one of my favorite in the portfolio. This is tucked seamlessly into Summerwood's residential fabric. It sits predominantly beside a newly built retail and highly visible to the community it serves. A Starbucks was literally just built right next door to the site, and it has deep residential roots with a few high-quality storage options that stand out as a go-to choice in the neighborhood. And there's really no competition for this site. The manager even acknowledged it when we visited the location. She said, look, this is where everybody stores. This is the local storage center, and it's buried in a neighborhood. And I'll show you on a map how it's just surrounded by housing. And this facility is purpose-built, 2015 build, making it the newest asset in the portfolio. And the mix is heavy climate controlled with 436 of the 490 units, catering to the needs of the nearby residential customers in this dense master plan neighborhood. So Summerwood, again, this location, look at it. It's just buried in the neighborhoods. There's nowhere to build additional storage, and it's just a classic infill winner. It sits directly on the main arterial road with strong traffic visibility, immediate access, and it's seamlessly embedded into this dense residential area, literally surrounded by rooftops. And it's in a submarket with very little competition. The demographics here, 61,000 people within 3 miles, and it sits near over 2,400 multifamily units that are coming online, right in the heart of a growing suburban pocket. So average household income, 114,000, and this property just thrives due to its dense built-out neighborhood with limited competitors. Now let's take a look at the Eldridge facility. Again, that's just a classic picture of just a property that's buried in a neighborhood with tons of multifamily housing, smaller units that need self-storage. And it's right in the heart of the energy corridor. So this submarket is one of the most economically resilient corridors. And it's anchored by major employers such as Shell, BP, ConocoPhillips, creating a dense competition of corporate offices, affluent professionals, and Class A apartment developments. Within 3 miles of this property, there's over 151,000 residents with average household incomes of $116,000 a year. And this is going to continue to attract long-term renters, homeowners, thanks to its job proximity and retail infrastructure. And nearly 59,000 net rentable, over 470 units, or about 470 units. The vast majority, over 80%, are climate controlled. It's, again, 2-story Class A, purpose-built in 2002, and its current occupancy is over 82%. After a while, you kind of look at these sites, and they're almost exactly the same, buried in rooftops. And that's why we love the Eldridge location. We always look for sites with strong traffic, dense rooftops, and this one checks every box. It's right on Eldridge Parkway with over 37,000 vehicles passing. It gives us exceptional visibility, top-of-funnel awareness, and it's surrounded in these dense neighborhoods. And it's also by well-known retailers. such as Target, TJ Maxx, Burlington, and many more within just a few blocks. It also sits in one of the densest pockets in West Houston, surrounded by over 347,000 people within 5 miles. And the 3-mile population is growing at 5.4%. That's 5 times the national average, and the household incomes exceeding 116,000. And with 3,300 new multifamily units coming in, the demand for storage is only increasing. Okay, moving over to Rosenberg. This sits squarely in the path of Houston's westward growth, and it sits within Summer Lake's master plan community. To Sugarland, the Grand Parkway, and US 59, this sits ideally positioned to serve both long-term residents and a steady stream of new movers looking for storage solutions in a modern, well-kept facility. I also noticed there was almost no competition in this market, which was excellent. So this facility, again, is modern. It's 2-story. It was built in 2015, over 60,000 net rentable square footage, 490 units. It's predominantly climate controlled, with 436 of those units being climate and the rest non-climate. Here's the location, again, buried in residential neighborhoods, with 15,000 cars that pass directly in front. And within just a minute from Interstate 69, traffic is over 100,000 vehicles per day. It's also surrounded by major retailers like Target, Home Depot, Kroger, Marshalls, which drive visibility and trip traffic. So this site sits right in the heart of a fast-growing residential pocket, adjacent to a master plan community, and just 5 minutes from Sugarland. Okay, so talking about Rosenberg, it's one of the fastest growing submarkets in all of Fort Bend County. With just the 1 mile of the property, the average household incomes top $172,000. And that affluence carries out through the entire trade area. So we're seeing steady population growth, especially in the immediate vicinity, with over 4% annual growth within 1 mile radius and nearly 3% across the 3 miles. All right, moving over to the Katy property. This facility is positioned right in the heart of the Cypress Katy market, one of the fastest growing and most in-demand corridors in all of the Houston metro area. And we're surrounded by explosive residential growth, anchored by high-income family neighborhoods and some of the top-ranked schools in the region. The Katy facility is right on South Fry Road. It's one of the busiest, most recognizable arterials in the area. It was built in 2003, and the site includes over 70,000 net rentable square feet, 475 units, and it's got that diverse 229 climate units and 217 non-climate units spread across 8 single-story buildings that gives customers a lot of flexibility and gives us a lot of leasing optionality. Again, this site is almost identical to the remainder of them. It's a standout location. It's right off South Fry Road, which gets 15,000 cars a day, and it's just down the road from Interstate 10, which is over 100,000 cars. And this means great visibility, strong drive-by traffic, and reliable demand from residential businesses and retail users alike. So this is the best demographics, I believe, in the portfolio, with 5.5% population growth, over 178,000 household income within 1 mile, 132 in the 3 mile. This market has grown over 58% in the last decade. The Katy market is exploding. They just keep adding more and more neighborhoods, and that further buries this and secures long-term success. So let's talk about the returns. We have 3 share classes. A is a $100K minimum, Class B, $1 million minimum, and Class C, a $2 million minimum. And you can see that this produces year 1 cash flow. Our cash flow is expected to begin 90 days after we close on the asset, which is scheduled to close in August. So our first distribution is anticipated in November of 2025. This will come with depreciation and a cost segregation study. So we're very excited about the returns that each share class produces and the overall cash flow that this property produces as well. Here's how we're sourcing the capital: $59 million of equity, and then we're getting a loan for $50.4 million of debt. So we have a great leverage on here. Very low leverage, very safe investment from that perspective. $109 million total project costs, $102 million going to the purchase, $3.5 million to the sponsor, $1.9 million to closing, $1.3 million to reserves, and $700,000 for improvements. We've set aside $100K per property to fix up and market the property better. This is the capital stack, and this is where the conservative strength of the deal really stands out. We're using just 49% leverage. which is low compared to most real estate deals in this environment. That means more equity in the deal, less debt pressure, and a significantly lower risk profile. And even better, we've locked in a fixed rate debt of approximately 5.75%, which protects us against interest volatility over the life of the investment. And we've structured a full term interest only period, giving us greater cash flow flexibility in the early years when it matters most. Put all this together, we're in for a strong foundation for downside protection while enhancing upside for investors through steady, tax-advantaged cash flow and potential appreciation. But I think one of the most important risk indicators in any real estate deal is the break-even occupancy. It tells us how much building needs to be occupied to cover both operating expenses and debt service. And in this case, we're looking at an exceptionally low break-even level starting at just under 60% in year one and declining steadily to about 54% in year 5 and just under 54% in year 6. And that's possible because we deliberately limited our debt exposure on this deal. So less leverage means less risk to the investor and more cushion if leasing takes longer than expected or market softens. So even if these properties aren't full, they're still generating enough income to comfortably cover our expenses, and that's really a position of strength. These are our different waterfall hurdles for each respective share class. Extremely favorable to the investor, offering a preferred return of 6, 7, or 9%, and then cash flow hurdles after that preferred return is met to the investor, favoring the investor 80-20, then 70-30 until certain hurdles are met, and then a 50-50 split thereafter. So this is open to accredited investors only. The minimum is $100K, and it's first come, first serve, and bonus depreciation is anticipated. IRAs and 401ks are accepted, and we're planning to close this investment in August. However, funding is now open, and those who fund in July will benefit from distributions that begin in November, but those who wait till August to fund, their distributions will not start until the December timeframe. So it benefits you to invest early to start accruing that return. And so I just wanted to go through a few of the questions that we've had from investors. So I think one of the major questions that people have right now is how did the big, beautiful tax bill impact this investment? And I will say that it's very exciting that it positively impacted this portfolio overall because bonus depreciation has now come back to 100%. This means as an investor, you're going to get the tax efficiency of 100% bonus depreciation, meaning you're going to have more taxes to shield against the income that you earn from these distributions. And by the way, I saw somebody ask, the distributions are monthly. So if you invest in July, they start in November, but then they occur monthly thereafter on the first of every month. Great question. The next question I see is what is your major concern about this portfolio? I see that this is generally a low risk portfolio, but what keeps you up at night? I love this question so much. So I would probably say what concerned us the most in this portfolio was how much property we're buying at one time. And the way we've mitigated that is we're actually not going to be the operator. We're going to partner with an operator who is already in the market in Houston. So CubeSmart already has a presence in the market. They already have a team, regional management, area managers, and store managers in the market. And they're very familiar with this market and these assets. And so by partnering with them, we mitigate a lot of the operational concern of scaling in a new market. Great question. The other thing I will say too is that we were concerned about too much leverage. You can't take out a huge loan, especially in this environment. So what we did was we purposely throttled back our leverage. Typical real estate transactions are 65, 70%, maybe even 75% LTV. We are only 49%. So that was a way that we really mitigated some of the risk in this investment opportunity. And so one of the questions that we had is what happens if rental growth slows or demand softens in Houston? And so like I was mentioning earlier, these assets are already well occupied in high barrier infill markets where demand is less volatile. So because we're not relying on any significant rent escalations or lease up to hit our pro forma, even modest performance would support our cash flow targets, and where low leverage and interest-only terms buffer against the downside. So what happens if the economy softens? So self-storage is a resilient asset class, historically performing well during downturns due to its downsizing, relocation, and transitional needs. And with our break-even occupancy well below 60% and strong market fundamentals, this portfolio is well positioned to weather economic headwinds. I love this question. Why wouldn't a REIT just buy these facilities themselves? Well, one of them tried. In fact, we had interest from the top tier REIT that wanted to acquire the portfolio outright, but we secured buying this through a long-term standing broker relationship and reputation, and this allows our investors to participate in institutional grade portfolio, usually reserved for large platforms like REIT operators. What's your exit strategy? So these are REIT quality infill assets that align perfectly with an institutional buyer demand. So our goal is to operate them professionally, maximize NOI, and exit to a REIT or recap through a private equity play or a private equity buyer targeting stabilized cash flow portfolios in supply constrained submarkets. So one of the questions I have is what are the next steps to invest? And that is here on our website. You go to Spartan-investors.com. You can click on this investor portal link on the top right. Once you log into the portal, we can send you a login to or an invite to our dashboard. You'll see the Houston portfolio deal. Once you click on that, this is the deal room I talked about in the beginning, where everything we discuss in the webinar you can find in this deal room. But most importantly, if you want to start the investment, there's a start investment button that you see on the screen here. And down below it, that's where you can find all of our operating agreement, PPM, offering memorandum, funding instructions, and our underwriting file. But I wanted to thank everybody for joining us, and we really look forward to having you participate in this investment. You'll get a replay of this webinar via email, and there'll also be a link to schedule a call to talk with one of our IR managers about this investment opportunity. So thank you everybody for coming out and tuning into our webinar. I'm excited to announce we're officially open for funding, and we look forward to having your participation in this investment. Thanks everybody.